Welcome back to Investing Talk Podcast. We're jumping right in today for a deep exploration of the latest info on Occidental Petroleum.
That's right. We're really going to try and unpack the key details from, the sources you sent over. We've got the Q1 2025 earnings market analysis. The goal is to get a clear picture of where Occidental stands right now.
Yeah, we looked at earnings excerpts, due diligence summaries, market updates, even stuff on their carbon management side. And just scanning it, a few things jump out right away. You've got that earnings beat, talking about cost cuts, and, well, obviously the big Berkshire stake.
Definitely. Feels like a lot going on.
It really does. Plenty to dig into, performance, strategy.
For sure. The sources give us a lot to work with.
Okay, so where should we kick things off? Maybe the Q1 financials. The top line looked pretty good from what I saw.
It did, yeah. They reported revenue of $6.84 billion, $6.843 billion to be exact, according to one source.
Okay.
And that was better than the analysts expected. They were looking for something like $6.71 billion.
And how's that stack up against last year?
Well, that $6.843 billion, that's actually a 14% jump compared to Q1 2024. So yeah, decent growth there on the revenue side.
Okay, solid top line. Then looking further down, earnings per share reported was 0.0077 cents, but the sources really focus on the adjusted number.
Right, and that's pretty common. The adjusted figure pulls out certain, one-off or less predictable things, helps you see the core operational profit better.
Right, things that aren't part of the day-to-day business.
Exactly, and Occidental's adjusted EPS for Q1, it was $0.87.
And that's the big beat, right? $0.87 versus what was expected. 69 cents.
Yeah, 69 cents was the consensus. So $0.87 is a, 26% positive surprise? Pretty strong signal about the core operations.
Definitely suggests things were running better than Wall Street thought.
For sure. And if you break it down by segment, looking at adjusted pre-tax income versus their guidance, midstream and marketing beat their midpoint by $127 million. And OxyChem also came in ahead with $215 million adjusted pre-tax.
Okay, so good performance there. What about the main engine, oil and gas?
Oil and gas was, the big revenue driver, pulled in about $5.7 billion in revenue, $1.7 billion pre-tax income. And the sources point to two things. Production volumes were up 19%, and they got help from rising commodity prices, too.
Right, a good combo. And the other parts, OxyChem and midstream.
So OxyChem, revenue of about $1.25 billion, $185 million pre-tax income. The sources say that beat expectations, even with some pricing and cost challenges.
Okay.
Midstream and marketing, though, different story. Revenue was $203 million, but they actually posted a pre-tax loss of $77 million.
Oof. Why the loss there?
Mostly due to losses on derivatives trading, according to the reports. Market swings hit that segment.
Got it. So oil and gas and chemical strong. Midstream took a hit from market stuff. Okay, that paints the Q1 picture.
Yeah.
How's this feeding into their strategy going forward, operationally?
Well, they did update their 2025 guidance. They actually reduced the midpoint for capital spending by $200 million for the year.
Reduced it. Interesting.
Yeah, and they also cut guided domestic operating costs by $150 million.
Okay, that's quite a bit. What are they saying is driving those cuts?
They're pointing to continued operational efficiency gains and better schedule optimization. Specifically mentioned the Permian and the Gulf of America. Sounds like they're just finding ways to do more with less.
And I saw something about rig reductions, too, for 2025. Does that mean they're planning to produce less?
No, actually, the sources are pretty clear on that. The rig reduction plan is about efficiency, not cutting output. But the idea is to keep production volumes steady, but lower the costs for each, they drill. Better capital efficiency, basically.
Right. Keep the oil flowing, but spend less doing it. Always the goal. So how did all this translate into cash flow in Q1?
Okay, key numbers here. Operating cash flow before working capital changes, that non-GAAP number was $3.0 billion, so $3,000 million.
Okay.
The standard GAAP operating cash flow was $2.148 billion, and capital spending, CapEx, was $1.908 billion in the quarter.
And EBITDA, that was up too, right?
Yep, EBITDA hit $3.567 billion. That's up 19.4% compared to Q1 last year. So pretty healthy cash generation from operations.
Now, there was that interesting note in one of the reports about how free cash flow was calculated. What was that about?
Yeah, that's a good flag. One source calculated free cash flow at $1.155 billion, but they pointed out this calculation included working capital and other,
Okay.
and their take was that this might be potentially a bit misleading compared to how free cash flow is maybe more standardly calculated.
Right. Definitions matter.
Exactly. The source basically says, hey, listener, you got to look closely and decide who you trust on this calculation.
Good point for anyone digging into the numbers. Okay, switching gears a bit, but still on financials, the debt. Always a big focus for Occidental. How does that look after Q1?
The sources peg net debt at roughly $22.18 billion at the end of the quarter.
$22 billion. Still a big number. Did they chip away at it in Q1?
They did, yeah. They paid back $2.3 billion of debt during the quarter.
Okay, that's significant. How'd they manage that?
The reports link it to asset sales they completed. Remember the Crown Rock acquisition back in August 2024? These sales followed that deal.
Right. Recycling capital.
Mm-hmm. The sources also give the specifics. Cash on hand was $2.612 billion, and the long-term debt, including the bit due soon, was $24.787 billion.
But even with that $2.3 billion repayment, I saw one source still calling the debt a significant concern. Why the continued worry?
Well, the argument in that source is basically that, yeah, they made progress, but the amount of free cash flow they're generating right now makes it hard to really aggressively pay down that much debt.
Especially with oil prices bouncing around lately.
Exactly. Especially with the recent drop in oil prices. Plus, they point out the interest expense is pretty hefty, around $1.2 billion a year. That adds risk.
Okay, so progress, but the mountain's still pretty high and depends a lot on oil prices.
Got it. Let's talk production. How much are they actually pumping?
Total production in Q1 came in at 1,391,000 barrels of oil equivalent per day, so nearly 1.4 million BOEPD. And most of that's driving the revenue, right? The upstream.
Oh, yeah. Accounts for like 83.3% of their total revenue. The key spots mentioned are U.S. Permian, Rockies, Gulf of America, and then international Algeria, Al Hosn, Dolphin, Oman.
Okay. Now, the stock has been on a bit of a ride. What do the sources say about recent performance?
Yeah, quite a bit of movement. It was down about 21% from its peak earlier in 2025. Peak was $53.20 and recently closed around $42.16. It even dipped below $35 the month before.
But the Q1 earnings gave it a lift.
It did.
Yep.
After that earnings beat on May 8th, the stock jumped almost 6%, closed around $41.33.
Still well off the highs, but better.
Right. Closer to its high over the past year, which was near $64.76, but still a ways off.
What's driving all this volatility in the market?
Well, the usual suspects, really. You've got worries about demand, especially from China, and just general global economic uncertainty kind of weighing things down.
But then you have offsetting factors.
Yeah, you've got geopolitical risks keeping a floor under things, plus OPEC, plus managing supply. It's a tug of war.
And one source mentioned something specific impacting Q1, a gray swan.
Yeah, that was interesting. It cited a gray swan event linked to a Trump-era thing called Liberation Day as contributing to the stock drop in Q1. The overall expectation near term, just moderate volatility.
Okay. What about the medium-term view for oil prices from these sources?
The outlook there seems, well, maybe cautiously optimistic, suggesting prices might trend higher, like into a $65 to $85 range, maybe even higher.
And the logic behind that?
It points to years of underinvestment in new oil production globally. Demand is expected to hang in there, even with the energy transition. U.S. production helps balance things, but it's growing more slowly, more disciplined this time around.
Oh, no more drill, baby, drill at any cost.
Seems that way.
Okay, and we can't talk Oxy without mentioning Berkshire Hathaway. Their position keeps growing.
Huge point. Yep, Berkshire kept buying. They now own over 28% of Occidental's outstanding shares.
28%. Wow. How's that typically read by the market?
Generally seen as a big vote of confidence, right? Strong institutional backing, a bullish signal, especially if you're a long-term value investor.
The sources also note that even with Buffett in their corner, the stock still took that big hit in Q1.
That's the reality check, isn't it? It shows that even a huge, respected partner like Berkshire can't completely shield a stock from broader market forces, commodity swings, and, sector sentiment. Fundamentals matter, but so does the macro environment.
Good point. Okay, let's shift to their newer stuff, the Lowcarbon Ventures.
Right. Lowcarbon Ventures. That's their subsidiary focused on tech and business ideas that, grow the company but also cut emissions.
And 1.5 is a big part of that, right? What's their focus?
1.5 is all about CCUS, carbon capture, utilization, and sequestration. They're working on decarbonization stuff, especially direct air capture, DAC. That's technology to pull CO2 right out of the air.
And they made progress on permits. I saw that mentioned.
Yeah, big step. They got Class 6 permits for their Stratos DAC facility. Those are basically the permits you need before you can start injecting the captured CO2 deep underground for storage or use. Crucial regulatory hurdle cleared.
Okay. And how does that stuff potentially connect back to their main oil business, like enhanced oil recovery?
Yeah, this is where it gets interesting, potential synergy-wise. If you pair DHAS with EOR, you can help with decarbonization, sure, but it could also really help Occidental's bottom line.
How so?
By using the CO2 they capture from the air for EOR, they could slash the cost of getting that CO2. One source mentioned CO2 cost is like maybe 40% of the total cost per barrel in their EOR operations right now.
40%. Wow. So using their own DT captured CO2 could make EOR much cheaper.
Potentially, yeah. It makes the low carbon venture potentially enhance the core business economics. It's not just about emissions.
Interesting angle. How are they paying for 1.5? Is Oxy footing the whole bill?
No, the plan is actually to minimize the capital coming directly from Occidental's main balance sheet. They're looking at a mix of things. Like what?
Government grants, loans, bringing in strategic equity partners, using project debt backed by policy incentives, maybe even selling off parts of the equity in 1.5 down the road, trying to get the cheapest money they can.
Makes sense. Any idea what that first big DDEC plant, DAC E1, will cost?
The estimates in the sources are around $800 million to $1 billion. That includes some early work for future DAG plants, too.
Okay, $1 billion. Not small change. So, pulling this all together, Q1 numbers, operations, debt, market stuff, these new ventures, what's the summary on risks and outlook from the sources?
Okay, key risks highlighted are macro stuff like interest rate changes, geopolitical flare-ups, things that hit oil prices, regulatory focus, especially on environment, though maybe that helps their low-carbon side too, higher raw material costs hitting the chemical business, supply chain snags, and like we talked about, that big debt load and the interest payments, about $1.2 billion a year. That's leverage risk.
So quite a few headwinds to watch. Definitely. So the picture painted is, solid Q1 operations, efficiency gains are real, they've got that huge Berkshire backing, and they're making strategic moves into low carbon. But they're facing big external challenges. Volatile commodity prices, global economy wobbles, and that debt is always there.
Right. It's a complex mix.
Yeah.
Okay, so to sort of recap the core story we've pulled from these sources, strong Q1 beat, making real strides on operational efficiency, allowing them to cut spending guidance, chipping away at debt with asset sale proceeds, massive confidence signal from Berkshire, and pushing forward with these strategic carbon management investments alongside the traditional energy side.
Yeah, that sums it up pretty well. A lot of moving parts.
So here's maybe the final thought to chew on based just on this material. You've got the crazy volatility of energy markets. You've got that significant debt. But you also have potential long-term value from getting leaner operationally in these low-carbon plays. Given all that, what factors should you prioritize when trying to figure out the future path for a company like Occidental? Something to think about. We definitely encourage you to check out the source materials we use for more detail and form your own view. And hey, please remember to subscribe, like, and drop a comment. Let us know what you think.